Hello, and welcome to today's Explainer. We're going to be unpacking the legal frameworks of corporate auditing under the Companies Act 2013. We're exploring a pretty massive challenge in corporate governance today. As a company scales up globally, how in the world does it keep its financial records perfectly accurate and compliant? We're going to see exactly how the law allows companies to divide and conquer their auditing responsibilities, with a special focus on branch audits and joint audits. So let's just get right into it.
Picture a modern multinational corporation for a second. We are talking about tens of thousands of daily transactions, completely massive volumes of data, and operations that are literally spread across the globe. How can a single auditor possibly manage that sheer volume and geographic spread? Well, the short answer is they can't. It's just too much. Thankfully, the legal framework provides some very specific mechanisms to split up that workload.
So here is our roadmap for today. We'll start with the Corporate Audit Challenge, move into Branch Audit Basics, and then look at Branch Auditor Duties. After that, we'll enter the Joint Audit, weigh the pros and cons, and finish up with the rules of co-auditing.
Okay, Section 1, the Corporate Audit Challenge, growing beyond the registered office. Every company starts in one place, right? The registered office. But as a business expands, keeping track of money miles away from headquarters becomes a huge challenge. The baseline rule here is Section 128(1) of the Companies Act 2013. It flat out demands that a company must keep books of account that give a true and fair view of its state of affairs. And crucially, this includes transactions at both the registered office and its branches. These books have to follow an accrual basis and use a double-entry system of accounting. Now, the board of directors can actually decide to keep these books somewhere else in India. But, and this is a big but, they have a really tight window. They have to file a written notice giving the exact address to the registrar within just 7 days.
Moving on to Section 2, Branch Audit Basics, the hub and spoke strategy.
So how exactly do we solve this geographic problem? We use a geographical division of labor. Under Sections 128 and 143, the law relies on branch audits to manage these spokes branching out from the headquarters, which is our hub. A branch audit strictly handles the records of transactions taking place at a branch office, and that's regardless of whether those physical records are stored at the branch itself, at the registered office, or honestly, anywhere else.
If we look at Section 128(2) and Section 143(8), there is a very exact flow of compliance. First, if a company has a branch, it's deemed perfectly compliant with the law if proper books of account relating to those branch transactions are kept right there at the branch office. Second, the branch has to periodically send proper, summarized returns back to the company's registered office. Finally, a designated branch auditor examines these accounts and submits their final report directly to the main company auditor. That main auditor then rolls it up into their overarching report. It's a brilliantly structured reporting chain. It ensures that distance is absolutely never an excuse for a lack of transparency.
Now, you might be wondering who actually gets to perform this audit. Well, the rules change depending on geography. If the branch is located in India, the accounts have to be audited either by the company's main auditor or by another person qualified for appointment as a company auditor under Section 139 of the Act. But if the branch is situated outside India, the law gives us some flexibility. You can use the company's auditor, an accountant, or really any person who is duly qualified to act as an auditor under that specific foreign country's laws.
Section 3 now. Branch Auditor Duties. Same powers, same rules.
The absolute most crucial point to take away here is accountability. A branch auditor is not some sort of lesser auditor. According to the Act, if a branch auditor is appointed separately, their duties and powers regarding the branch audit are exactly the same. Identical to those applicable to the main company auditor under subsections 1 to 4 of Section 143. They have the full right to access books, demand information, and inspect records. They must prepare a report and send it to the company auditor. Furthermore, the really strict provisions of Section 143(12) regarding the mandatory reporting of fraud, those extend right to the branch auditor for anything relating to their specific branch.
Let's pivot to Section 4. Enter the joint audit. Co-head chefs in the kitchen. Okay, so what happens when a single organization is just way too large and complex, even at its core headquarters? We have to move from a geographic split to a division of sheer workload. By definition, a joint audit refers to conducting the statutory audit of a single organization using more than one auditor. Large companies with highly diversified business operations use this strategy all the time. The basic aim here is to pool the vast resources of multiple expert auditors to conduct the audit way more efficiently and in much less time. It's kind of like putting multiple expert head chefs into the exact same kitchen so they can prep a massive, complex banquet together.
Section 5. Pros and cons. Weighing the trade-offs. Because let's be real, having multiple head chefs can sometimes lead to chaos.
Let's look at both sides of the coin here. On the benefits side, a joint audit drastically reduces the workload of a single auditor and speeds up completion times. By sharing expertise, multiple auditors can solve highly critical problems together. Plus, there's often a healthy competition among them that actually improves the quality and speed of the work. You get this incredible benefit of extensive, pooled knowledge. But notice the tension here. There are limitations. This strategy is totally unsuitable for small entities because of the massive cost burden. Furthermore, established auditors might develop a bit of a superiority complex over the less experienced ones. That kind of ego clash, combined with a lack of coordination, can actually slow the work down. It can create uncertainty over who is liable for what, and shockingly, areas of common concern can end up being completely neglected. Oh, and of course, the auditors have to share the fees, which they might not love.
Which brings us to Section 6. Rules of Co-Auditing. Navigating SA 299.
To prevent issues like a lack of coordination and unclear liability from totally ruining the audit, the profession relies on standard frameworks to establish clear ground rules. First up, work must be meticulously divided, documented, and communicated so that those areas of common concern we just talked about are not neglected. Second, coordination is absolutely paramount. Without strict written communication before finalization, things just fall apart. Third, there's a principle of dependence. You can generally assume your co-auditors followed standard procedures for their chunk of the work. And finally, reporting. If the auditors actually disagree on the financial truth, they aren't forced to just go with the majority. They must express their different opinions in separate reports.
And that brings us to our final thought for today. We've seen how the Companies Act uses branch audits to conquer geographic spread and how joint audits conquer massive workload complexity. Both of these solutions involve a ton of structural planning, precise communication, and yes, added costs. So I'll leave you with this provocative question to ponder. As a corporation scales into a massive global giant, is the high cost of managing multiple auditors simply the unavoidable price we have to pay for absolute financial trust? Think about that trade-off between the cost of compliance and the immense value of transparency.
Okay, picture this. You've just been tasked with auditing a massive multinational corporation. We are talking about operations spanning the globe, subsidiaries operating under completely different legal systems, and literally thousands of financial transactions happening every single minute. The reality, one auditor or even a single audit firm simply can't do it alone. You need a team of highly skilled professionals working in perfectly synchronized tandem. But how do you prevent that from turning into a chaotic mess? Well, welcome to this explainer where we're diving into our definitive playbook for navigating exactly this scenario. We're going to decode the rules of the game.
I mean, it's basically the ultimate logistical challenge, right? When you have multiple independent auditors, often from entirely different firms, tackling a single giant entity, how do you make sure they don't duplicate work, miss critical red flags, or just descend into total chaos? How do you actually ensure everyone is pulling in the exact same direction without constantly stepping on each other's toes?
Well, the answer lies in something called SA 299, formerly known as the Responsibility of Joint Auditor. This is our ultimate rulebook. It officially prescribes the strict guidelines on exactly how joint auditors have to divide their work, how they must coordinate their findings, and, perhaps most importantly, how they share liability. Think of SA 299 as laying down the absolute law for co-auditors who need to function like co-chefs in a massive, high-stakes commercial kitchen. Every chef needs to know their station, and everyone needs to know exactly who is responsible if the soup gets burnt.
So to really master this standard, we're going to break it down into 5 definitive plays of our SA 299 playbook: dividing the audit work, the need for coordination, who is actually responsible, trusting your co-auditors, and finally, delivering the final report.
Okay, let's dive right into this with Play 1, dividing the audit work.
Before you even look at a single ledger, our joint auditors have to figure out who does what. Just like those co-chefs taking over different stations, one on the grill, one on pastry, joint auditors must sit down, mutually discuss, and divide the audit work among themselves. The most common logical way to do this is by identifiable units or specified areas, like different branch locations or subsidiaries. But depending on the nature of the business, that geographical division might not always be possible. In those situations, SA 299 allows them to divide the work by items of assets or liabilities, by income or expenditure, or even with reference to specific periods of time throughout the financial year.
Now, there is a massive caveat here.
Owing to their extreme importance, or just the really complex nature of the work involved, certain critical areas of the audit are never divided. They absolutely must be covered collectively by all the joint auditors. And whatever that final division of labor actually looks like, who's doing what and what's being done together, it has to be adequately documented and preferably communicated directly to the entity being audited. The client needs to know exactly what the game plan is.
Moving right along to Play 2, the need for coordination.
So, once everyone is at their respective stations, communication between our co-chefs literally becomes a matter of professional survival. Imagine an auditor, deep into reviewing the Liabilities division, suddenly stumbles across a piece of information that heavily impacts the auditor reviewing the Assets division. What do? Well, SA 299 is very strict here. You can't just casually mention it over coffee. If an auditor comes across matters relevant to another auditor's area, something that deserves their attention, requires their judgment, or needs disclosure, they are required to communicate it to all other joint auditors in writing. This formal submission of a report or note has to happen prior to the finalization of the audit.
All right, let's get into the high-stakes stuff. Play 3, who is actually responsible? Now, what's really interesting about this is, if your partner completely messes up their specific part of the audit, are you on the hook for their mistake? SA 299 answers this by completely dismantling the myth that everyone is equally liable for everything in a joint audit. It very carefully separates individual responsibility from joint responsibility. It essentially creates this firewall that protects diligent auditors while ensuring collective accountability where it matters most.
Let's break down exactly what triggers joint and several liability, meaning the areas where the entire audit team stands or falls together. First, they're jointly liable for any audit work that was not divided and carried out by all of them. Second, they're jointly liable for the appropriateness of decisions they all make concerning the nature, timing, or extent of the audit procedures. Third, they share responsibility for matters brought to the joint notice of everyone on which there's an agreement. And critically, they are all on the hook for examining that the financial statements comply with statutory disclosure requirements and for ensuring the final audit report itself complies with the relevant statutes.
But, and this is a huge but, here's the critical distinction you have to remember. While all the joint auditors are jointly responsible for agreeing on the recipe, meaning the appropriateness of the decisions regarding the nature, timing, and extent of the audit procedures, actually cooking the dish correctly remains an individual liability. The proper execution of those agreed audit procedures is the separate and specific responsibility of the joint auditor assigned to that task. If you agree on the procedure, sure, you share liability for the plan. But if your partner executes their part of the plan poorly, that falls entirely on them. Also, a quick side note. If an auditor brings up an issue after the final audit report has already been submitted, the other joint auditors are legally not responsible for it.
Which brings us to Play 4, trusting your co-auditors.
Listen, if you're auditing a massive global entity, you literally cannot recheck everything your partner does. You defeat the entire purpose of a joint audit. So SA 299 legally engineers trust right into the system. As the standard explicitly states, each joint auditor is entitled to assume that the other joint auditors have carried out their part of the work correctly. Let me emphasize this point. It is not necessary for a joint auditor to review the work performed by their partners or perform tests just to ascertain if the work was actually done properly. You are legally allowed to trust their professional competence.
And, this legally mandated trust actually goes even further. You are explicitly entitled to rely upon the other joint auditors to bring to your notice any departure from generally accepted accounting principles or any material error they might notice during their specific course of the audit. You assume they're doing their job, and you assume they're going to wave a massive red flag if they spot something disastrous in their assigned jurisdiction.
Let's move to and see how this all builds up to Play 5, delivering the final report.
This is the moment where all that planning, execution, and trust coalesces into a final professional opinion. Normally, after all the work is done, the joint auditors are able to arrive at a consensus, issuing a unified, agreed report. That's the ideal scenario, right? But what happens when highly skilled professionals look at the exact same financial data and fundamentally disagree on the matters to be covered in the report? Well, SA 299 has a very strict mechanism for dissent.
So, the absolutely crucial point here is that auditing, it is not a democracy. A joint auditor is not bound by the views of the majority. If there's a disagreement among the team regarding matters to be covered in the report, each dissenting auditor should express their own opinion through a separate audit report. Your professional judgment literally cannot be outvoted.
And that really brings us to the core of SA 299. It's a standard that so meticulously balances the heavy burden of individual professional responsibility with the absolute necessity of mutual reliance. It really makes you wonder, as we look at the immense complexity of modern corporate auditing, is an auditor's greatest asset their own individual expertise or the legally mandated trust they must place in their partners? It's a fascinating balance, and understanding it is absolutely key to decoding the world of joint audits.
Look, when regulators zoom in on the corporate world, their absolute biggest nightmare is management fraud. And to minimize that risk, they put strict corporate governance codes into play. But let's be real, rules on a piece of paper just aren't enough. You need an enforcer. You literally need an ultimate internal safeguard. So today, we are demystifying exactly what that safeguard is, the Audit Committee.
Okay, let's dive into this. Here's our roadmap for today. We'll start by defining this corporate watchdog, then look at who actually needs one, how to build the committee, their core duties, their frankly amazing investigative superpowers, and finally, the whistleblower shield.
All right, Section 1, the corporate watchdog. So to really understand why this committee exists, we kind of have to start with the main problem, which is management fraud. Now, an independent audit is great. It can reveal all sorts of hidden frauds buried deep in the corporate accounts. But what if the management actually controls the auditor? Seriously, who watches the corporate watchers? How on earth do we eliminate that conflict of interest? Like, say, when an auditor is also acting as a highly paid consultant for the exact same management team they're supposed to be auditing? The answer is you need a specialized, totally independent shield. And that is exactly where the Audit Committee comes in. It's a separate committee set up specifically to review the auditor's performance and make absolutely sure they are independent. Now, to be fair, this whole concept isn't entirely new here in India. Clause 49 of the listing agreement issued by SEBI actually specified this a long time ago. But back then, it was limited only to listed companies. The real game changer was the Companies Act of 2013. That act broadened the scope massively and brought way more companies under this strict governance umbrella. So if you're an investor who just wants to ensure your money is safe, this is the exact body protecting your interests.
Moving on to Section 2. Who needs an audit committee?
Okay, so which companies are actually required to form this super exclusive club today? Well, it's no longer just those massive publicly traded giants on the stock exchange. Under Section 177(1) of the Companies Act, read alongside the 2014 rules, yes, every listed company's board of directors must have one. But look at the financial thresholds for unlisted public companies. I like to think of this cleanly as the rule of three: capital, turnover, and debt. If a public company has a paid-up capital of 10 crore rupees or more, a turnover of 100 crore rupees or more, or, when you add it all up, outstanding loans, borrowings, debentures, or deposits exceeding 50 crore rupees, they are legally mandated to form an audit committee. Basically, if a company is dealing with a significant chunk of public or borrowed money, the law says you need a watchdog in place. Which brings us to Section 3, building the committee.
So, we know who needs one, but who actually gets to wield the power on this committee? Well, if we contrast the standard General Board of Directors with the Audit Committee, the differences are pretty stark. The General Board oversees overarching operations, right? But the Audit Committee has highly specific structural requirements under Section 177(2). It has to consist of a minimum of 3 directors, and a majority of them absolutely must be independent directors. And here's the really interesting part. It's not enough to just be independent. A majority of the members, and this includes the chairperson, must actually have the ability to read and understand financial statements. I mean, it makes perfect sense, right? You can't have a watchdog that doesn't know how to read the complex financial documents they're supposed to be policing. All right, Section 4, core duties and functions. So stepping into their actual playbook under Section 177(4), the board has to specify their terms of reference in writing. And this brilliantly illustrates how their heavy legal functions are chunked logically into 3 main areas. First up, auditor management. They are the ones recommending the appointment and the pay of the company's auditors, and they are constantly reviewing and monitoring that the auditor is staying independent and that the audit process is actually effective. Second is financial scrutiny. They aren't just glancing at the numbers. They are deeply examining the financial statements, the auditor's report, and evaluating the company's internal financial controls and risk management systems. And finally, corporate approvals. They're tasked with approving or modifying transactions with related parties, strictly scrutinizing intercorporate loans and investments, and monitoring exactly how funds raised through public offers are actually being used. Let's turn to Section 5, investigative superpowers.
Now, to truly be a watchdog, you need teeth. And under Section 177(5) and 6, this committee has some serious authority. They can demand the comments of the auditors regarding internal control systems and the scope of the audit. Crucially, they get to review the financial statements before those statements are ever even submitted to the general board. They can pull the internal and statutory auditors or even management into a room to discuss related issues. And if something looks fishy, they have the full legal authority to investigate any matter related to their duties or anything referred to them by the board. Plus, they get unrestricted access to information in the company's records. Management literally cannot legally hide the books from them. So the absolutely crucial point is this specific quote right from the law: power to obtain professional advice from external sources. Think about that. If the audit committee finds some complex web of transactions they don't quite understand or they suspect foul play, they don't have to rely on the company's internal lawyers or accountants. No way. They have the power to go right outside the company, hire external experts, and get independent professional advice to help their investigation. This is what makes their investigative power feel so tangible and so dramatically independent. And this adds a massive layer of corporate accountability. Now, you might be wondering, okay, but what happens if the audit committee makes a recommendation and the general board of directors just, decides to ignore it? Well, Section 177(8) handles exactly that scenario. If the board does not accept a recommendation from the audit committee, they are legally forced to disclose that rejection in the board's annual report. And not just that, they have to provide these specific reasons why they chose to ignore the watchdog. They essentially have to publicly justify their actions to the shareholders. Now, for Section 6, the whistleblower shield. This really brings us to the climax of this explainer. You see, the committee isn't just looking at spreadsheets and interrogating auditors. They are fundamentally responsible for protecting the human element, the actual people who are brave enough to speak out when things go sideways. Under Section 177(9), there is a strict mandate to set up what's called a visual mechanism. So, every listed company, plus those companies accepting public deposits or borrowing over 50 crore rupees from banks and financial institutions, must establish this system. It acts as a formal, safe channel for directors and employees to report genuine concerns about wrongdoing, fraud, or mismanagement happening inside the company. But let's be honest, a reporting system is completely useless if employees are terrified of being fired just for using it, right? If you're working at one of these companies, you really need to know your rights. Section 177(10) steps in here with specific legal shields. The mechanism must provide adequate safeguards against the victimization of anyone who uses it. And more importantly, it mandates that in appropriate or exceptional cases, the whistleblower has the right to bypass management entirely. They get direct access to the chairperson of the audit committee. And just to ensure everyone actually knows this safe channel exists, the company is required to publicly disclose the establishment of this mechanism on its website and right there in the board's report. So we've seen the financial thresholds, the strict composition rules, the investigative superpowers, and those vital whistleblower protections woven right into the Companies Act. The regulatory framework is robust, for sure. It's designed specifically to bring objective evaluation, integrity to financial information, and real protection for all stakeholders. But at the end of the day, it all rests on execution. So I want to leave you with this to ponder. In practice, is the corporate watchdog you rely on truly independent, exercising its vast powers to seek the truth, or is it just a regulatory box checked for show? Thanks so much for joining this explainer, and keep asking the tough questions.